What's up guys, Kieran here and you're very welcome to the channel. So I've been doing a lot of digging lately, looking for investment cases. And the market is fraught with high valuations, especially the electric vehicle market, where investors are just flooding in to try and buy up any electric vehicle company they can. One sector, however, that's still ripe with despair is the 3D printing industry. This is in stark contrast to 6 years ago in 2014, when this industry was also fraught with high valuations. As like most crazy bubbles of lust though, the stocks came crashing down and then simply fizzled sideways up until today. So I thought I'd dig a little deeper into this industry and see if I could find any nice investment opportunities. I'm hearing and seeing lots of things through various sources that are talking about Industry 4.0 and how 3D printing is going to lead the way. Needless to say, all this has piqued my interest. For this video, I'm going to take a quick look at the 3D printing market landscape and see if I can see what all the fuss is about. I'm also going to take a look at a 3D printer stock from a company called Stratasys. I'm looking at Stratasys because they're arguably pioneers of the industry, but their stock is also incredibly beat down. I put a lot of time into writing, recording and editing these videos, so if you want to show me some love back, just give me a thumbs up, and if you haven't yet, consider subscribing to the channel. My goal with this channel is to bring you useful information that you can use to make better investment decisions. So if that's something you're interested in, then stick around. Okay, so let's firstly take a look at the sector as a whole. And I'll start by taking a look at what Ark Invest think of the industry, because like most innovative sectors, they're usually my first source to go to get information. So Ark Invest believes that this industry is still in its infancy. While it's grown over the last decade to take 40 to 50% of the prototype market, it still has not infiltrated the end-use parts market, which Ark Invest believe to be worth 490 billion in market potential. So let me explain a little bit the difference between the prototype industry and the end-use product industry. So in the prototype industry, customers are only looking for maybe 1 of or 10 of a prototype to be made, and historically they would have had to pay huge costs to get tooling made up to make these very small number of parts. They would have waited for significant lead times for the tooling to be made and then for the product to be made. Generally then they would assess the physical prototype, make changes to the design, and then they'd have to go back and do iterations of this over and over again. And not only was this costly and did it take a long time, but with legacy manufacturing methods, they were limited in terms of what they could actually design. It had to be designed for manufacture essentially, because you could only manufacture certain designs. With 3D printing then, basically you can manufacture anything. It doesn't matter how it's designed in terms of where the fillets are, where the joins are, etc. It's also much cheaper to produce very low volume, so you don't need to get tooling made up. One 3D printer can basically make any design so long as it's given the correct drawing. This means much cheaper prototypes, much shorter lead times. So it's no wonder that 3D printing basically stole 40 to 50% of this market, and I'm sure it's going to continue to steal more. The end-use product market then, we're talking about massive runs, massive volumes, and for this market it's actually much cheaper to go and invest in the capital, get your tooling made, get your molding machine set up. Once you have all your investments done, then you can make huge volume and you can recoup that over months and years. So I can understand how 3D printing hasn't taken this market yet, but obviously Ark Invest are expecting this to happen. So let's dig a little deeper and see what they think. So you can see that they're expecting the industry to grow from about 10 billion in 2018 all the way to nearly 100 billion in 2024 at a staggering growth rate of 65% annually. And they're not the only firm expecting growth within the industry. Take Wohlers for example. While far less impressive than Ark Invest forecast, they're still expecting significant growth in this industry. Each year Wohlers releases its annual report on the 3D printing industry, and each year they've upped their forecasts. The 2019 report forecasts 15.8 billion in industry revenue for 2020, 23.9 billion in 2022 and 35.6 billion in 2024. While it's not 65% compound annual growth, it's still massive growth. What's really caught my attention lately though is how 3D printing has been in the media during the pandemic. The media has been awash with stories of individuals and companies making parts and supplies for the medical industry. They've made it much needed PPEs like face shields and made a lot of spare parts for the likes of ventilators that the medical industry would have gone without otherwise. And this really showcases the flexibility provided by 3D printing. One machine that can essentially make any part so long as it has a drawing. This is in stark contrast to legacy manufacturing methods such as injection molding, where big, heavy and expensive tooling is required, and it's only cost effective, as I said, to do massive runs. So this kind of press might shift the sentiment for 3D printing, as it reminds people of the value proposition that 3D printing can offer. It offers the potential for on-demand and flexible supply chains that are sheltered from global risks such as the one that we've had. And the pandemic has made governments really aware of just how fragile their supply chains are. I mean, it's one thing being without your $1,000 iPhone, but it's another when the medical sector cannot even get a 10-cent swab to do tests because they all come from China and there's no supply route. All this is now likely leading to a retraction in globalization and more on-demand localized supply chains. My bet is that 3D printing is going to have a huge part to play in this supply chain transformation that's inevitably going to come over the next few years. So while the revenue of 3D printing stocks has been hit hard during the pandemic, I expect that they're going to see tailwinds over the next few years as industries transform their supply chains. Okay, so now let's take a look at Stratasys. Okay, so some companies are definitely doing better than others, and Stratasys, as I said, is one of the most beaten down stocks in the 3D industry that I could find. The stock is currently trading at $15. That's down 89% from its high of $130 in 2014. And if you invested in this stock all the way back in 2003, 17 years ago, your returns to today would have been zero. Actually, it'd have been negative when you factor in inflation. So this is a really bad investment story for anybody who invested in this company. But on a slightly more optimistic note, and one of the reasons that I'm looking at this company is that Ark Invest actually own 25% of the company. Now naturally, when you look at the past performance of this company, you have to ask yourself why. I mean, past performance doesn't necessarily mean future performance. But I have to wonder if the good people at Ark Invest maybe know something that we don't know. And actually, I suspect that they do, and I'm going to tell you why now in a minute. So a little bit about this company. So they claim to be the world's leading 3D printing company, pioneers of the industry for over 30 years, and they now offer end-to-end 3D printing solutions, from 3D printers themselves to a wide range of materials and various 3D printing software solutions. The industries they serve include aerospace, automotive, consumer products, dental, medical, education, railway and art and fashion. In 2019, Stratasys produced total revenues of $636 million, and that came from products and services. I'd say about 70% of it came from products and the other 30% from services. And they operate in America, Europe and Asia Pacific, but predominantly in America. Now, as I mentioned, Stratasys has experienced rather stagnant growth, and actually since 2014, year on year their revenues have actually declined. You can see here on Yahoo Finance, decline in revenues since 2016. Now the only upside to this is you can look at their negative earnings are actually decreasing in terms of how negative they are. The company itself is trading for a total market cap of 816 million. And here you can see the stock price since the high of 130 in 2014. It's just crashed all the way down to a price of $15 today. In Q1 of this year then, their revenue decline was even exacerbated by the global issue, and revenues declined 14% year over year. Not a great sign for a high growth industry all the same. Both the company's products and services businesses experienced year over year declines. As of February this year, the company appointed a new CEO, and in the press release the phrase "our next phase of growth" was mentioned once or twice, clearly showing that this new CEO has one goal, and that's to turn this company around. What's really piqued my interest is an interview I watched with Tasha Keeney, who's an analyst over at Ark Invest who covers this space. And when she was asked about Stratasys' declining revenues, this is the answer she gave.
Tasha, I want to start with Stratasys, which is basically part of the 3D printing story. What's going on here? I would think that this would be in a lot of demand right now if there's supply chain problems and hang-ups for getting parts.
Yes. So Stratasys is certainly one of the most undervalued 3D printing companies. It's trading like a value stock. It has a price to book ratio below 1. And what we clearly think is a growth industry. We think 3D printing is around $10 to $15 billion today in its market, and it could go to roughly $90 billion in the next 5 years. So there's two sides to this story right now. So 3D printing, it comes in, it's very key in a time like the current pandemic, because it basically allows you to, certainly in plastics, create parts cheaply and very quickly. So if you need a part fast and you don't want to wait for the injection molded tool to print it, you're going to look to something like 3D printing. So we've seen all those face shields that have been 3D printed. They're 3D printing nasal swabs, but they're also 3D printing pieces of actual medical equipment that's going into hospitals because they need those parts fast. The other side of this is, well, what's happening with the other traditional industries that are not the medical space that are using 3D printing? And, of course, this is to buy a 3D printer, that's a capital decision. So you would see sort of in the shorter term some delay in those capital purchases. But in the longer term, certainly coming out of this pandemic, we think companies, there'll be supply shortages. I mean, we've already sort of seen that as certainly sort of the auto industry and these more industrial industries have started to ramp back up after the shutdown period. There's going to be supply gaps. And again, if you need parts fast, you're going to look to something like 3D printing. In fact, Airbus, that's how they first got to using Stratasys technology for some of their parts. They were in a pinch and they needed the parts fast. They still use the technology today because it has so many advantages. It saves on cost, it saves on weight, and that can be huge for an aerospace player, especially on the margin side. So I think longer term, sort of that's the story with 3D printing, that it helps you bring manufacturing closer to home, and it helps you solve those supply gaps. So I think there'll be this other sort of burst that we'll see coming out of that industry.
So why is the company been so flat in its revenue for the last 5 to 6 years? I'm looking at the yearly revenue between 600 and 700 million. It's actually declined the last couple of years coming into this. Are they not getting big industrial customers to renew contracts? Are they not figuring out the perfect products to be printed on a regular basis? What's going on there?
Yeah, so to talk a little bit about the history with 3D printing. So, in the 2014-2015 period, there's this consumer hype phase, the idea that there'd be a printer in everyone's house. That never materialized, and we don't think it ever will. In fact, the best use cases for 3D printing are in industries like healthcare and aerospace. And those industries also happen to be highly regulated, and it takes time for these companies to work 3D printing into their specifications and to get those parts approved. So I think investors coming out of that consumer hype phase were sort of expecting a faster acceleration of those exciting end-use part applications, parts that go into the final product versus a prototype. But it takes time. So I think we are, in terms of that top line revenue growth, they've had this period now where they've been able to work with companies like Airbus, like Boeing, and work their way into those specification requirements and those approvals. And certainly, for in the medical space, we've had insurance codes for 3D printed parts are a new thing. You couldn't previously get coverage on some of these 3D printed implants. So we've really been laying those backbones over the past few years. So again, I think going forward, that's where you'll sort of see, that work pay off.
So I'm not sure about you, but basically what I get from that is that Stratasys has been putting in the foundation for growth over the past couple of years. Now, I can speak to this because I work in the medical and pharmaceutical industries. And in order to change the manufacturing processes, it takes years because you need to validate your new processes and you need to get regulatory approval. And this takes huge amounts of work and huge amounts of time. And these industries are very, very slow to change. So it makes sense to me that if these industries started trying to put 3D printing into their processes, it would take years for that to actually lead to increasing revenues for Stratasys. So I expect that Tashin knows that there's new or increased revenue streams coming online in the near future. I can't confirm this, but it's just an indication I have based on that conversation. If we look at earnings, Stratasys has failed to turn a profit over the past couple of years. But looking at the earnings, as I mentioned, level of loss has been decreasing over time. and it seems that Stratasys have been putting in the time to make their organization more efficient. This trend of decreasing losses shows a path to profitability in the future. This is really echoed by its recent announcement that it's going to lay off over 10% of its workforce. And while this is good for the bottom line, it doesn't really fill me in confidence in terms of the growth they expect. But the announcement did lead to a JP Morgan analyst updating his price target for the stock up to $22. That's a 45% upside from today's price of $15. In terms of margins, product gross margin ranging around 58 to 57%, and we can see a decline for Q1 of this year, but again, that's explainable due to the pandemic. The service margins are less, they're around 30%, but because this doesn't make up as big of a business as the products, the average total gross margin then kind of comes in around 49%. So relatively speaking, this is a healthy enough margin, and it should be enough for Stratasys to turn a profit in the future. Where things get really exciting then is when we look at Stratasys' balance sheet, which in my view is extremely healthy. So we can see here in terms of cash and cash equivalents, Stratasys have 297 million in cash on the books. They've short-term deposits of 28 million and then accounts receivable of 115. Now their inventories are growing at 172 million from 168 million last year. And this isn't a great thing to see really. You want to see declining inventories. But look, it's not the end of the world. If you look at the non-current assets then, such as property, plant, goodwill, etc., you get a total assets value of 1.3 billion. Now we have to take some of this with a pinch of salt, but it's still an impressive balance sheet, especially when you look at the lack of liabilities and the lack of debt. This company has essentially no debt, which is really, really promising. So I'm very confident that Stratasys can weather whatever storm comes out of this pandemic and hopefully be alive to see the tailwind coming to this industry in the future. Another positive story is that Stratasys are cash flow positive, and we can see that in Q1 of this year they generated cash flows of 11.3 million. So while it's not a lot, it's still cash flow positive, which is a very good sign. What gets me really excited about Stratasys really, it's its overall valuation. So Stratasys is trading at an extremely cheap price to sales multiple, with 636 million in revenue in 2019 and at a market cap of 815 million. They're trading at just 1.3 times earnings. Now where things get really interesting is if we minus the 300 million in cash and cash equivalents that they have on the books, that earnings multiple drops to 0.8. So 0.8x earnings they're trading for. Now if we look at it from a balance sheet perspective, they have 1.3 billion on the books in assets, and seen as they're trading for 850 million, basically you're buying this business at 0.6 times total assets. So while the company isn't growing, it is in a growing industry, and it's very rare that you would see a company in a growing industry trading at these kind of multiples. This really is a value play at its finest. Okay, so it seems despite the obvious growth in the industry, Stratasys has struggled to see any growth itself. The future of this business is not clear to me, but there is a few indications that this might be a turnaround opportunity. The new CEO laying off 10% of his workforce, declining losses, which might lead to profitability, and future revenue streams coming online. While it's unlikely that Stratasys are going to end up dominating this industry, my expectation is that the revenue and scope of the industry is going to grow so much that it will provide Stratasys with a place in the industry and hopefully growth in the future. The other possibility is that Stratasys ends up being a takeover target for a larger company such as HP, who are also trying to become leaders in this industry. If Stratasys can turn it around, this could be a very profitable investment. As I said, it's not often you find a value play in such a high growth industry. As with all value stocks though, there's a risk that this is a value trap. And honestly, as it stands, I don't have enough information to make that call. So what I'm going to do is I'm going to pick up a couple of shares just because I think it's too cheap to ignore. And I'm going to keep researching this company, and I'm going to keep researching the wider industry and other companies within the industry. If I find a better opportunity, then I'll take it. But potentially, I suspect I might end up doubling down on Stratasys if I find out more good news, or if more news comes out about the company indicating future growth or increased profitability. Let me know what you think in the comments below. Do you have any insider information into this business or into this industry that you can share? I'd really appreciate it. Also, don't forget to give me a like if you appreciate this video and consider subscribing if you haven't yet. Thanks for watching and have a lovely day.